Welcome, Stock Explorers, to a focused discussion designed specifically for you. Today, we're taking a deep dive into EVgo, a prominent name in the United States' rapidly evolving electric vehicle fast charging market.
Yeah, and our goal here is really to equip you as a potential investor with a clear, comprehensive understanding of EVgo. We'll look at their business model, dig into the financials, operational side, market position.
And importantly, their path towards profitability, basically trying to give you the full picture on EVgo.
Exactly. Consider this your direct route to some informed insights.
All right, let's kick things off with the basics. EVgo's core business. What exactly are they doing?
Well, fundamentally, they own and operate a network of public fast charging stations. Their main thing is selling kilowatt hours of energy.
So they sell us the electricity for our EVs.
Precisely. And they're strategic about where they put these stations. Think high-traffic urban, suburban spots, often near, shops or restaurants. Amenities.
Makes sense. And these aren't the slow chargers you might have at home, are they?
No, definitely not. EVgo focuses on DC fast chargers. Much higher power, much quicker charging times. Really crucial for people who are out and about, need a quick top-up.
Right. Convenience is key.
Absolutely. That focus on high-traffic areas with things to do nearby, that's very deliberate. Make charging part of the routine, not just this separate chore.
Oh.
And their network's been growing quite a bit.
Yeah, I saw that. In Q1 2025 alone, they added, over 180 new operational stalls?
That's right, which brought their total count to 4,240 stalls by the end of March.
Yeah.
Mostly public, but also some dedicated, and they're extended ones too.
And they're not slowing down, are they? The plan for 2025 is pretty ambitious.
Yeah, they're targeting between 1,200 and 1,400 new stalls for the full year.
Wow.
And looking longer term, it's even bigger. They have this major goal held by that big DOE loan to essentially triple the network size by 2029.
Triple it. Well, that requires some serious capital and execution, doesn't it?
It absolutely does. Which brings us to strategy and, importantly, partnerships. They're not doing this alone.
Right, like the GM and Pilot Company collaboration, that seems pretty significant.
Oh, hugely significant.
Yeah.
They're aiming for 2,000 DC fast chargers at up to 500 pilot travel centers. This hits that long-distance travel pain point head-on.
Tackling range anxiety on highways.
Exactly. Leveraging Pilot's existing spots and GM's customer base. That's smart. Gives them prime real estate, a built-in audience.
And they're making progress there.
Definitely. Over 130 locations already active in more than 25 states. They're even talking about flagship stores.
Interesting. And beyond just location, it's about the experience too, right? Amenities for travelers while they charge.
Precisely. And speaking of smart moves, that AI-driven site selection, also with GM, is pretty clever.
Using data to find the best spots.
Yeah, looking at things like EV traffic patterns, what amenities are nearby, even housing density, trying to get ahead of the demand curve.
It's like predicting where we'll need to charge next. And there are other partnerships too. I saw Mijer mention.
Yep, an expanded deal with Mijer, the grocery chain. Could mean up to 480 new chargers across the Midwest. So charge while you shop.
Convenient.
And there's the Impact vision with Toyota. Co-branded stations popping up in California, plus complimentary charging for new BZ4X owners.
So tying charging directly into buying the car.
Exactly. It builds loyalty, integrates the experience. These different deals show how they're tackling various segments, various use cases.
Makes sense. What about the tech itself? Reliability is always a big topic.
It is, and that's where their joint development with Delta Electronics comes in. They're working on next-gen charging hardware.
Aimed at improving reliability.
Reliability, yes, but also, crucially, lowering costs. They expect a pretty significant 30% drop in the gross capital cost per stall starting late fiscal 26.
30%.
Oh.
That's a big number for future profitability.
Absolutely. And they've already got their first shipment of these new BABA-compliant chargers from their Texas factory. BABA-compliant just means they meet certain domestic manufacturing and standards requirements. Got it. Lower CapEx is always good news for investors. And the partnerships extend beyond just car companies, right? Well, yeah. Nissan, BMW, Ford, Hyundai, Kia, Tesla compatibility, but also fleet operators. Think rideshare like Uber and Lyft. That's huge. About a quarter of their network volume, apparently.
A quarter. Wow.
Yeah. Plus delivery companies, fleet management firms like Merchants Fleet. It's quite diverse. Actually, over half their Q1 throughput came from rideshare, OEM credits, and subscriptions.
So not just relying on individual drivers showing up.
Exactly. That diversification gives them a more stable base.
Yep.
On the tech side, things like Plug and Charge or Auto Charge Plus are gaining traction.
Makes charging easier, right? Just plug in and go.
Pretty much for compatible cars, no apps, no payment terminals needed. It accounted for like 27% of sessions in Q1. Simpler user experience.
That has to help with adoption. And network usage is growing overall.
Significantly. Network throughput, the amount of energy sold, was up 60% year-over-year Q1, hit 83 gigawatt hours.
And individual chargers are busier too.
Yet the average daily throughput per public stall is up, and overall public network utilization rose to 24% in Q1. That means the existing assets are working harder, generating more revenue.
Those are strong operational metrics. Better utilization means more kilowatt hours sold.
Directly. And strategically, they seem pretty confident about handling potential charger tariffs.
Because they're sourcing more domestically.
Partly that, and also the CapEx savings from the new tech. They're also really pushing expansion in fleet charging solutions, given how important that segment is.
And that big DOE loan is the main funding engine for all this expansion, getting them towards, well, eventually positive cash flow.
That's the plan. It's the primary capital source as they move beyond adjusted EBITDA and target free cash flow break-even. And they keep stressing, they're selling kilowatt hours. It's an energy business, not just equipment.
An important distinction. And they're tackling reliability.
Through their Renew maintenance program, yeah. Keeping chargers working is obviously vital for customer trust and revenue. Overall, they're bullish on long-term demand, just given EV adoption trends.
Okay, so a lot happening operationally. Let's pivot to the financials. Always a crucial piece for potential investors.
Absolutely. And Q1 2025 showed, well, a bit of a mixed picture, but definitely strong growth. Record total revenue, $75.3 million. That's up 36% year over year.
And it beat analyst estimates, right?
It did. And importantly, their core charging network revenue also hit a record, $47.1 million, up 49% year over year. That's 13 straight quarters of double-digit growth in that segment.
That consistent charging revenue growth is definitely a positive sign. Demand seems strong.
It does. But on the other side of the ledger, they're still reporting losses. The net loss for Class A stockholders was $11.4 million in Q1.
Okay, and the GAAP loss was higher.
Right, the GAAP net loss was $26.2 million. GAAP includes all expenses, things like stock comp, depreciation. The non-GAAP figure gives a sense of operations, but isn't the bottom line.
But that $11.4 million loss was actually an improvement compared to last year.
Yeah, about a 7% improvement year over year.
Yeah.
So the losses are narrowing, which is the right direction. And looking ahead, they stuck with their full year 2025 revenue guidance.
And that guidance midpoint is above current analyst consensus, isn't it?
It is, which suggests some confidence internally. Perhaps even more encouraging, though, is the target for adjusted EBITDA break-even this year in 2025.
Adjusted EBITDA. Remind us what that covers.
Earnings before interest, taxes, depreciation, and amortization. It's a non-GAAP measure of operating profitability. Their guidance range is minus of $5 million to plus $10 million. So the midpoint is slightly positive.
So potentially breaking even on that operating measure this year. But crucially, that's not the same as overall GAAP profit, right?
Correct. Still not GAAP profitable. And importantly, they're not generating positive free cash flow yet either. Free cash flow is the cash left after capital spending. It was negative $25.24 million in Q1.
Okay, so still burning cash, but maybe improving.
The cash used in operations did improve year over year, down to $10.2 million in Q1. And their cash balance actually went up significantly by the end of the quarter to $171 million.
Because of the DOE loan money coming in?
Exactly. Those first drawdowns boosted the cash position. But, Wall Street still expects them to use around $110 million in cash for the full year 2025.
So the DOE loan is crucial for bridging that gap.
Absolutely. Management's target is what they call leverage-free cash flow break-even in 2026. That comes after hitting the adjusted EBITDA break-even target this year.
So a phased approach. Reduce losses, hit EBITDA break-even, then aim for positive free cash flow. That's the trajectory investors need to watch.
That's the key path. Looking at debt, it was about $76.3 million long-term debt at the end of Q1, but importantly, their cash on hand exceeds that debt.
Which is a good position to be in, liquidity-wise.
Definitely. And again, that DOE loan guarantee up to $1.25 billion over 5 years for 7,500 stalls, that's just transformative for their funding. They drew down $75 million in January and another $19 million in April.
Okay. What about margins? How profitable is the core business?
Well, the Q1 GAAP gross margin was 12.4%, pretty flat year over year. But the charging network gross margin actually dipped a bit.
How is that?
They cited higher maintenance costs, property taxes, and also some one-off revenue from breakage in the prior year that didn't repeat. But their adjusted gross margin, which strips out some items, actually increased year over year to 33.7%.
So underlying profitability might be improving.
That's the suggestion. And the plan is to boost those margins further with operational efficiencies and that cheaper next-gen tech we talked about.
Right, the lower capex per stall.
Exactly. Now, market cap-wise, they're hovering around, say, $850 to $870 million recently. What's interesting is that their cash balance makes up a pretty significant chunk of that, maybe around 20%.
That's quite a bit of cash relative to their market value. What about stock ownership?
We saw some increased institutional buying towards the end of 2024. Big names like Millennium, D. Shaw, Vanguard added shares. Casalo Capital, Soros Fund Management also established positions around then.
Which can be seen as a vote of confidence from larger investors.
Often, yes. But we also have to remember that secondary offering back in December 24, the big shareholder, LS Power's affiliate, sold a large block of shares at a discount.
And that put pressure on the stock price at the time.
It did. A reminder that large shareholder actions can definitely impact the stock, and there's potential volatility.
So, summing up the financials. Strong revenue growth, big investments funded largely by the DOE loan, a clear path outlined towards profitability, but still burning cash and not yet GAAP profitable. Execution is key.
That sums it up well. Critical period for them to deliver on those targets.
Now, how does EVgo stack up against the competition? ChargePoint, Blink, others?
Yeah, it's a competitive space. Valuation-wise, some analysts see EVgo as potentially the cheapest on a forward price-to-sales basis compared to ChargePoint and Blink.
Though cheap depends on hitting forecasts, right?
Always. Blink, for instance, has struggled with EBITDA profitability and cash burn. ChargePoint has its own targets. Reliability is another comparison point. User reports vary across all networks. It's an industry challenge.
But EVgo reported pretty good numbers.
They did a 95% one-and-done successful charge rate in Q1, which is strong. And, JP Morgan recently upgraded them to a buy rating.
What does EVgo say differentiates them?
They really hammer home the owner-operator model. They own the assets. Also, they're tight focused purely on DC fast charging, unlike some others with mixed networks, and of course that significant DOE financial backing.
And they claim they're gaining market share in new DCFC stalls.
That's their claim, yes, in that fast-growing segment. Their strategy of locking up prime locations via partnerships and using AI for site selection is definitely part of their competitive edge.
And there was that talk about potentially capitalizing on the Tesla supercharger situation after their layoffs.
Right. The CEO mentioned potentially acquiring sites Tesla might abandon or even hiring some of their laid-off talent. Opportunistic thinking, potentially.
Okay, broadening out, again, industry trends, external factors, how are they navigating those?
Well, their business obviously depends on EV adoption growing, especially non-Tesla EVs, which are their main user base right now. And that segment is growing nicely.
What about potential political changes affecting funding?
They seem to feel relatively insulated. They don't expect a huge hit from tariffs due to domestic sourcing plans, and crucially, that DOE loan is already secured, independent funding.
So they kept their 2025 guidance despite those potential headwinds.
They did, which sends a message of confidence. Long-term, forecasts still show strong EV sales growth, meaning more demand for charging. They believe DCFC demand will outpace supply for a while.
Any mention of things like electric motorsports or being a buyout target?
Nothing concrete in what we reviewed.
Yeah.
No specific talk of motorsports involvement, and not explicitly labeled as a buyout candidate, though that's always possible in this consolidating space.
And the risk of a recession impacting EV sales?
That's definitely a macro risk. A significant downturn could slow EV adoption, which would naturally impact demand for public charging. They remain optimistic, but it's a factor.
Okay, so let's talk path to profitability again and the risks involved. Why aren't they profitable now?
Mostly due to the massive investment in expansion building up. Building out that network costs a lot up front. Plus, ongoing operating costs, R&D, getting customers, standard for a high-growth phase.
And the steps to get profitable.
It's about increasing revenue, more chargers, higher utilization, and cutting costs, operational efficiencies, that cheaper next-gen hardware. The big milestone is hitting adjusted EBITDA break-even this year.
We saw their cash burn is still there, but improving. The DOE loan helps, but comes with conditions, right?
Yes. Disbursements are tied to meeting milestones over 5 years. And while the loan reduces the immediate need for, say, selling more stock, the risk of future dilution is always there if growth plans accelerate further or take longer.
Standard risks for a growth company? What else?
Market volatility, economic conditions, definitely. The pace of EV adoption itself. Operational risks, just the challenges of scaling rapidly, permitting, utility, supply chain. Tech obsolescence is always a risk too.
And regulatory hurdles.
Always a possibility in an evolving space. We didn't see specific data on short interest, but that can influence stock price too. And, how management handles things if they miss targets is important for shareholder confidence.
Okay, let's gauge the mood. What's the sentiment among analysts and investors right now?
It seems there was a pretty positive shift, especially on platforms like StockTwits after the Q1 earnings. People felt better after seeing the numbers.
What were the main positive takeaways for them?
The strong earnings beat, definitely. The DOE loan confirmation is huge, those big partnerships. Network growth continuing, and importantly, reaffirming the 2025 guidance.
But investors still have concerns, presumably.
Oh, sure. The lack of historical GAAP profit is still a big one. The ongoing cash burn, the stock's past volatility, execution risk, can they actually deliver on these ambitious plans, competition, and just general concerns about charger reliability, even though EVgo's numbers look good.
What about Wall Street analysts? What are they saying?
Generally, the sentiment seems positive lately. Consensus leans towards buy or strong buy on sites like TipRanks, Wall Street's. Price targets suggest significant potential upside from where the stock has been trading. Ron Capital, for example, bumped their target up after Q1.
So analysts seem to think it might be undervalued, assuming execution.
That seems to be the general view based on their models and forecasts hitting those milestones.
How are investors interpreting key things? Management communication.
Seems like communication after Q1 was well received. That increase in institutional ownership we mentioned is often seen as a positive signal too.
And the focus is really on that 2025 adjusted EBITDA break-even target.
Very much so. That's the near-term proof point many are watching. Maintaining guidance despite potential headwinds was also seen as reassuring.
Any other points investors seem to like?
Some talk about a potential snowball effect growth building on itself. The strategy to buy American-made chargers seems popular. And just the basic expectation that as more stalls open, revenues should keep climbing.
So what's the overall fundamental investor outlook then? Bullish? Bearish?
I'd say cautiously bullish based on recent momentum. You have strong growth. The DOE loan is a game changer. There's a clear path outlined to EBITDA break even. But the risks are still there. No GAAP profit yet, execution needed, competitive market.
So potential reward, but definitely comes with risk.
Exactly. The risk-reward balance might be improving, but it's still a growth story that needs careful watching.
Okay, let's wrap this up. Final analysis, strategic outlook for EVgo.
Well, they've undeniably made big progress. Network expansion is real, revenue growth is strong. That DOE loan is truly transformative for their plans. Operational metrics are moving the right way, and management has set clear financial targets.
But challenges remain.
Absolutely. Achieving sustained cap profitability is the big one. Managing competition. Navigating those external factors, economy, policy shifts.
So strategically, what's key for them going forward?
Hitting those profitability milestones is paramount. Deploying that DOE capital efficiently and effectively. Staying ahead on tech and customer experience reliability is huge here. And just being nimble, adapting to how the EV market continues to evolve.
So the conclusion?
EVgo is definitely positioned to be a major player in EV charging, but it's still a high-growth, high-risk situation. Recent progress, especially the loan and the push for EBIT to break even, makes the story more compelling. But investors need to be aware of the execution risks and the competitive landscape.
Well, thank you for joining us today, Stock Explorers, for this detailed look at EVgo. Hopefully this gives you valuable context for your own research.
Yeah, remember, this is just part of the picture. Do your own homework. And if you found this deep dive helpful, please subscribe, give us a like, hit the notification bell. You know the drill. It helps us bring you more analyses like this.
And we'll leave you with a final thought to chew on. Considering the massive investment pouring into EV charging infrastructure and the clear growth in demand, what role do you foresee companies like EVgo ultimately playing in shaping the future of how we move and use energy? Something to think about.